The moment has arrived. The financial world is trembling as the Federal Reserve's latest actions rippled across the markets, sending U.S. physical silver to unprecedented highs over 100 per ounce. This isn't mere speculation. This is history unfolding, a tectonic shift in the monetary system that could redefine wealth, power, and security in ways most people aren't ready to grasp. For decades, silver has been dismissed by mainstream investors as a minor player compared to gold, yet history tells a different story. Silver has always been the metal of crisis, the refuge when fiat money falters, the hidden weapon in a world dominated by central banks and paper promises. Now, after years of artificial suppression, silver is reclaiming its place at the heart of global finance, and the Fed just opened Pandora's box. The US dollar, long considered the backbone of the world economy, is showing cracks that were once invisible. Inflation, long dismissed as transitory, is accelerating, and real-world purchasing power is eroding. People are waking up to the reality that cash is not wealth, physical assets are. Among these, silver is the silent giant, now roaring louder than ever. Investors around the world are scrambling. Physical silver is disappearing from exchanges, coin shops, and vaults. Online platforms report weeks, long delivery delays, premiums on bullion rising sharply, and demand outpacing supply like never before. The question on everyone's mind is simple: why now? The answer lies in the subtle but profound maneuvers of the Federal Reserve. The Fed, tasked with controlling monetary policy and stabilizing the economy, has unleashed a wave of liquidity, printing money at levels that defy logic. Trillions of dollars injected into a fragile banking system have one intended effect: prop up failing assets and maintain the illusion of stability. Yet, the side effect, unintended or perhaps deliberate, is a surge in the price of hard assets, most notably silver. Every move by the Fed is watched by economists, traders, and governments. When interest rates were manipulated, when quantitative easing expanded, when balance sheets ballooned, few realized the ultimate impact on precious metals. Today, that impact is undeniable. Physical silver is soaring, and the market's reaction is raw, emotional, and global. Consider this: 1 week ago, silver traded around 32 per ounce. Today, it has crossed 100, a nearly tripling in value in record time. This is not a correction, a spike, or a short-term frenzy. This is structural, systemic, a reaction to forces far larger than day traders or hedge funds. Central banks cannot suppress it. Governments cannot easily control it, and ordinary investors who remain in cash are losing real wealth by the hour. Wealth preservation is no longer theoretical, it is survival. Those who understand the lessons of history, who recognize the recurring patterns of inflation, currency devaluation, and financial crisis, are moving decisively into silver, gold, and other hard assets. Those who ignore it are at risk of watching their purchasing power evaporate while headlines focus on stock indices, crypto volatility, and market sentiment. Silver, unlike digital assets, is tangible. It is universally recognized, historically trusted, and immune to the whims of banks and central authorities. A coin, a bar, a physical ounce, it represents real wealth in a world increasingly dominated by ephemeral numbers on a screen. And today, that reality has hit home. The Fed's actions have accelerated this awakening. But why call it Pandora's box? Because once the public sees the fragility of fiat money and the potential of silver, once the floodgates open, there is no turning back. Demand could overwhelm supply, premiums could skyrocket, and the market could enter a new paradigm where paper currency is secondary to tangible, real-world assets. For decades, institutions have tried to suppress silver, short it, and manipulate prices. That era is ending. The ripple effects are global. Countries with large reserves of silver, miners, and industrial users are all affected. Mining operations are under pressure as the price incentivizes production, yet extraction is slow, complex, and limited by physical constraints. Retail investors find scarcity in stores, online orders face delays, and premiums soar. The imbalance between paper promises and physical reality is stark. At the same time, the Fed faces a dilemma. Their tools, interest rate hikes, liquidity injections, quantitative easing, cannot fully control the real-world markets for hard assets. They can manipulate bonds, control short-term lending, and adjust monetary signals, but they cannot conjure silver out of thin air. And when physical silver is in short supply, market panic can escalate quickly, with cascading effects on other commodities, equities, and currencies. This is why timing is critical. Every moment that passes, more money chases limited silver. Every day, the average investor waking up to inflation, debt, and central bank intervention considers the safety of tangible assets. The Fed may attempt to reassure markets, but reassurance does not create more silver. The law of scarcity is unforgiving. Investors should also understand that this is not simply a financial phenomenon, it is psychological. The realization that traditional banking systems and fiat currency may fail triggers behavioral shifts. People move toward things they can see, touch, and store. Silver in its various forms, coins, bars, ETFs backed by physical metal, becomes a symbol of certainty in a world of uncertainty. To understand the significance, one must look at history. During previous financial crises, silver played a critical role. From the Great Depression to the 1970s inflationary period, silver protected wealth when paper assets faltered. Today, we are witnessing a modern echo of those times, amplified by a globalized economy, hyper-connected markets, and the unprecedented scale of monetary interventions. The question isn't whether silver will rise, it already has. The real question is how high can it go, and what happens to the rest of the financial system in response. Gold is rising in tandem, but silver, due to its industrial use, lower market cap, and historical suppression, reacts more violently. A move from 32 to over 100 is a shock to the system, a wake-up call for investors, governments, and central banks alike. Meanwhile, market participants face a complex landscape. Hedge funds try to short sell, speculators ride momentum, and institutions scramble to cover positions. Volatility is extreme, yet liquidity in physical silver markets is tightening. The old strategies of buying and selling at will are no longer sufficient. Physical possession, storage, and secure custody become paramount. For ordinary investors, this is a historic moment. A decision must be made. Act now or risk being left behind. Physical silver is finite. Warehouse stocks, mints, and bullion dealers are being emptied. Every ounce purchased today is an ounce that cannot be immediately replaced tomorrow. And as more people recognize this reality, the market dynamics accelerate exponentially. The Fed's role is undeniable. Their actions, intended to stabilize banking systems and support the economy, inadvertently triggered one of the most significant moves in silver history. This is a lesson in unintended consequences, in the delicate balance of monetary policy, and in the limits of centralized control over tangible wealth. The story of silver is also the story of money itself. From barter to gold standards, to fiat currency and digital money, silver has been a constant, a hedge, a reliable store of value. And now, as fiat currencies face mounting pressure, silver steps into the spotlight, revealing weaknesses in the financial system and opportunities for those who act decisively. This is just the beginning. The initial surge is over 100, but there is reason to believe that the next phase could be even more dramatic. Global demand, geopolitical tensions, inflationary pressures, and market psychology all point to continued upward momentum. Physical silver is no longer a niche investment, it is central to understanding the future of money. Those who study these patterns, who pay attention to the interplay between central banks, inflation, and hard assets, see the signals clearly. The surge in silver is not a random spike. It is the market correcting decades of suppression and manipulation, realigning value with reality. Every ounce of silver now represents more than wealth. It represents foresight, prudence, and financial literacy. Those who recognize the shift and act early may preserve and grow their wealth, while those who ignore it face erosion, uncertainty, and the frustration of hindsight. As the world watches, the Fed continues its balancing act. Liquidity injections, rate changes, and market interventions will follow, but the fundamentals of supply and demand cannot be altered with words or spreadsheets. Physical silver remains finite, and its value is becoming impossible to suppress. We are witnessing history. The rise of silver to over 100 per ounce is not just a number on a screen, it is a warning, a lesson, and an opportunity. Centralized monetary control has limits, and tangible assets have enduring value. Those who see this moment clearly understand that the Fed has opened Pandora's box, and once the forces within are unleashed, they cannot easily be contained. The implications are vast. Inflation, currency valuation, wealth preservation, market volatility, and global economics are all intertwined. Physical silver sits at the center of this storm, a beacon for those prepared to understand, anticipate, and act. As silver continues its meteoric rise, the global perspective becomes crucial. Investors are no longer looking at the US alone. Physical silver demand is surging across Asia, Europe, and the Middle East. Countries like India, China, and Turkey have historically recognized the value of precious metals as wealth protection, and now they are moving decisively. Vaults are being emptied, coins and bars are being hoarded, and the global market begins to feel the strain of unprecedented demand. Mining production cannot keep pace. Silver is not like paper, it cannot be printed at will. Mines require months to produce, refine, and ship bullion to buyers. Even large-scale producers are struggling to meet orders. Industrial demand further tightens the supply, as silver is essential in electronics, medical devices, solar panels, and countless industrial applications. The same metal that acts as a store of wealth is also irreplaceable in modern technology. This dual role magnifies its scarcity, and as prices soar, the market begins to price in not just investment demand, but industrial necessity. The Fed watches cautiously. Officials understand the danger once a tangible asset like silver escapes the realm of control. It challenges their ability to manage inflation and maintain confidence in fiat currency. Their monetary policy is designed to manipulate liquidity and interest rates, not control physical metals. Yet the reality is unavoidable. Supply is limited, demand is growing, and price surges create feedback loops of panic buying and speculative frenzy. For retail investors, the moment is urgent. Physical silver is the most tangible form of wealth protection. Unlike ETFs or paper contracts, which can be influenced by brokers and market makers, holding bullion in your possession is final. Coins in a safe, bars in a vault, silver stored under lock and key. These are assets that no financial institution can devalue through mismanagement. Institutional investors are taking note. Hedge funds, pension funds, and family offices are scrambling to adjust their positions. Silver ETFs are facing record inflows, and premiums for physical delivery spike. The narrative is no longer about paper wealth, it is about tangible physical security. The realization is spreading fast. Hard assets are the ultimate hedge against systemic risk. Geopolitics adds fuel to the fire. Global tensions, sanctions, and trade conflicts are all pressuring currencies. Central banks may attempt to stabilize economies with traditional tools, but these tools cannot generate physical silver. In times of uncertainty, nations and individuals alike turn to metals that have endured for millennia. The irony is that actions intended to stabilize markets often accelerate the rush to silver, creating a self-reinforcing cycle. Historical precedent cannot be ignored. During the 2008 financial crisis, gold surged as investors sought a safe haven. Silver followed, albeit more slowly. Today, the speed and magnitude of the rise are unprecedented. Technology, information flow, and global connectivity amplify market reactions. Social media, financial news outlets, and online investment platforms spread awareness instantly, creating mass behavior that accelerates purchases and drives scarcity. Understanding the psychology behind these moves is critical. When markets recognize scarcity, the fear of missing out drives irrational behavior. Investors who hesitate watch as premiums rise and delivery delays worsen. The Fed may announce measures to stabilize markets, but once tangible assets are in demand, the market often acts faster than central authorities can respond. This dynamic is particularly evident in U.S. physical silver. Dealers report record shortages, and online platforms warn of weeks-long delays. Investors who bought at $32 per ounce now see their holdings triple in value, while latecomers face higher prices and uncertain availability. The shift is tangible, the market is no longer theoretical. Physical reality has overtaken paper speculation. Meanwhile, silver's industrial use continues to apply upward pressure on prices. Technology and green energy sectors demand silver for photovoltaic cells, electronics, medical applications, and emerging industries like electric vehicles. As the world moves toward renewable energy and advanced technology, demand for silver will remain strong regardless of investment trends. This dual demand, industrial and investment, creates a structural floor under silver prices, making the 100 per ounce milestone more than just a temporary spike. The Fed's interventions, intended to calm markets, have inadvertently accelerated these trends. By flooding the system with liquidity, they have diminished confidence in fiat currency. Investors, fearful of inflation eroding cash holdings, seek refuge in tangible assets. Silver, with its historical reliability, becomes the obvious choice. Each policy action, each statement by the Fed, now ripples through the silver market, reinforcing the surge. Financial advisors are now advising clients to reconsider asset allocation. Traditional portfolios heavy in stocks and bonds may not withstand inflationary pressures. Diversification now includes precious metals as a central component. Silver, in particular, offers both historical security and immediate upside potential. The market is teaching a hard lesson: tangible assets cannot be ignored, especially when fiat systems falter. Every ounce of physical silver bought today is a hedge against uncertainty, a shield against currency devaluation, and a signal of foresight. Those who act swiftly gain not only wealth protection but the potential for substantial appreciation. The urgency is compounded by global supply limitations and rising demand across multiple sectors. Pandora's box, once opened, cannot be closed. The Fed may attempt to guide markets, but physical realities and investor psychology move independently. Each policy announcement triggers new waves of demand as individuals and institutions alike seek to secure tangible assets. The silver market, long suppressed by manipulation and paper trading, is now asserting its autonomy, and the pace of change is breathtaking. The coming weeks will reveal the magnitude of this shift. Silver may continue to climb, attracting speculative interest alongside genuine investors seeking security. Premiums for physical delivery may spike further, and shortages may worsen as global awareness grows. Those who understood the patterns early find themselves at a historic advantage, while those who waited may struggle to acquire silver at reasonable prices. The narrative is clear: silver is no longer a secondary asset. It is central to wealth preservation, financial literacy, and understanding the broader economic picture. Inflation, monetary policy, supply constraints, and investor psychology converge in one simple reality: tangible assets have become indispensable. As the world watches this transformation, individuals must decide how they respond. Will they recognize the value of physical silver, take action, and secure wealth? Or will they remain tethered to fiat currency, subject to the whims of central banks and market volatility? The choice is urgent, and the consequences are real. Physical silver over 100 per ounce is more than a number. It is a signal, a warning, and an opportunity. The Fed has set events in motion that cannot be easily reversed. Markets are responding, investors are reacting, and the global perception of wealth and security is evolving. The lesson is clear: tangible assets endure, Fiat systems fluctuate, and those who understand this fundamental truth are empowered to act decisively. Investors now face a landscape unlike any in modern history. The rise of silver to over 100 per ounce is more than a price movement. It is a structural event, one that challenges assumptions about money, markets, and monetary control. Understanding the implications requires a clear-eyed view of both opportunity and risk. Diversification is no longer optional, it is essential. Traditional portfolios, heavily weighted in equities, bonds, and cash, are exposed to the effects of inflation, currency devaluation, and systemic risk. Physical silver offers protection that cannot be replicated through digital assets or paper contracts. The metal is tangible, scarce, and universally recognized. Every ounce held represents real purchasing power that cannot be created or destroyed by policy statements or liquidity injections. The industrial demand for silver adds an extra layer of security. Unlike gold, silver is not only an investment asset but a critical industrial commodity. Electronics, renewable energy, medical technologies, and high-tech manufacturing all require silver in varying quantities. This creates a built-in floor under prices. Regardless of speculative interest, industrial necessity ensures that demand remains strong. Markets may fluctuate, but the fundamental need for silver cannot be ignored. For individual investors, timing is critical. Each day that passes sees premiums rising, warehouse inventories depleting, and delivery delays worsening. Orders placed even a week after the initial surge face higher costs and longer wait times. The lesson is clear. Early action secures both wealth and opportunity. Hesitation can result in higher costs and reduced availability. At the institutional level, the surge in silver is forcing rapid adaptation. Hedge funds are adjusting positions, pension funds are reconsidering allocation models, and family offices are seeking physical custody solutions. ETFs backed by physical silver are facing record inflows, driving the need for secure storage and delivery. The market is no longer theoretical, the shift is tangible and measurable. Geopolitical factors amplify this trend. Currency instability, trade conflicts, and sanctions all increase the perceived value of hard assets. Nations with large reserves or strong mining sectors find themselves in advantageous positions, while those reliant on fiat currency experience increasing pressure. This dynamic further cements silver's role as both a strategic and financial asset. Historical patterns reinforce the urgency. During periods of monetary instability, tangible assets outperform paper assets. The 1970s saw silver surge amid inflation and currency devaluation. The 2008 financial crisis highlighted the protective qualities of gold. Today, silver combines the characteristics of both scarcity, industrial necessity, and safe haven status. The current market is unprecedented in scale and speed, but history provides a roadmap for understanding potential outcomes. Behavioral psychology also plays a critical role. As awareness spreads, fear of missing out accelerates purchases, creating feedback loops that drive prices higher. This is not speculation in isolation, it is a natural reaction to scarcity and perceived value. Central banks, including the Fed, may attempt to influence sentiment, but the market for physical silver is largely independent of digital or paper controls. Scarcity and human behavior dictate outcomes. Investors must also consider storage and security. Physical silver requires careful custody. Coins bars, and bullion must be stored in secure locations, whether personal safes or professional vaults. The integrity of ownership is paramount, as markets respond not only to price signals but also to the availability of physical assets. Custody, verification, and security are part of the investment equation. The surge in silver has broader implications for global finance. As tangible assets gain attention, trust in fiat currencies may weaken. Inflationary pressures, fiscal deficits, and monetary policy missteps combine to erode confidence in paper wealth. Silver, by contrast, represents enduring value, independent of policy or central authority. Those who recognize this dynamic early have the potential to protect and grow their wealth, while others face diminished purchasing power. Financial literacy is the ultimate hedge. Understanding the mechanics of money, markets, and commodities empowers investors to make informed decisions. Physical silver is not simply a speculative bet, it is a strategic tool in wealth preservation. Knowledge, combined with timely action, ensures that assets remain secure and responsive to evolving market conditions. For corporations, silver's rise introduces both opportunities and challenges. Companies involved in mining, refining, and distribution benefit from higher prices, while manufacturers face increased input costs. Strategic planning and hedging become critical. The interconnected nature of global markets means that every move in silver reverberates across industries, currencies, and investment portfolios. The Fed, despite its extensive toolkit, cannot fully control these outcomes. Interest rates, quantitative easing, and liquidity injections influence markets, but physical scarcity and global demand impose real-world constraints. The surge to 100 per ounce demonstrates the limits of centralized monetary control and highlights the power of tangible assets in shaping economic reality. For the individual investor, this is a decisive moment. Physical silver is not just an investment, it is a shield against uncertainty. It represents foresight, prudence, and the ability to act amidst volatility. Every ounce acquired today is a step toward preserving wealth in a world where fiat currency faces mounting challenges. The broader economic lesson is clear markets respond not only to policy but to human behavior, scarcity, and tangible reality. Silver's rise is a demonstration of this principle. Paper assets may fluctuate, digital currencies may surge or crash, but tangible metals remain a reliable benchmark of value. As prices continue to climb, the feedback loop intensifies. Media coverage draws attention, social platforms amplify sentiment, and investors worldwide take notice. Scarcity drives urgency, urgency drives demand, and demand reinforces scarcity. This cycle can create dramatic swings, yet it is rooted in a simple truth: tangible assets cannot be created at will. Silver's role in financial planning evolves in this environment. Beyond short-term gains, it serves as a long-term hedge, a store of value, and a critical component of diversified portfolios. Investors must consider allocation, storage, and liquidity. Those who ignore these considerations risk exposure to volatility, while those who act strategically can secure enduring value. Pandora's box has been opened. The Fed's policies intended to stabilize financial systems have accelerated the recognition of tangible assets. Physical silver, scarce and in demand, stands at the center of this transformation. Investors, institutions, and nations alike must respond to this new reality. The coming months will test strategies, reveal vulnerabilities, and reward foresight. Silver's rise to over 100 per ounce is more than a market phenomenon. It is a lesson in economics, human behavior, and the enduring value of tangible wealth. Those who understand and act will navigate uncertainty with confidence, while those who hesitate may face diminished purchasing power and missed opportunity. In this environment, knowledge is power and action is essential. Silver is more than metal, it is a symbol of foresight, resilience, and financial literacy. The surge to 100 per ounce is both a warning and an invitation. Investors must recognize the opportunity, understand the dynamics, and secure tangible assets before scarcity and demand further escalate prices. Silver's rise to over 100 per ounce is sending shockwaves through every corner of the financial world. Investors, institutions, and even governments are waking up to a reality that has long been ignored. Tangible, scarce assets matter more than paper promises. In this environment, strategies for wealth preservation are evolving rapidly. Hedging, diversification, and secure storage are no longer optional, they are essential. Hedging begins with awareness. Understanding the relationship between inflation, monetary policy, and physical assets allows investors to position themselves effectively. Traditional hedges, such as bonds or cash, are increasingly vulnerable as fiat currencies lose purchasing power. Silver, by contrast, offers a dual role. It is both a tangible store of value and a metal with critical industrial demand. The combination creates a unique hedge, protecting against monetary instability while